Good evening, guys. Thanks for joining in today. Last time, probably in the session, we had Vibha Sen, who discussed about analytics and how marketing strategies can be leveraged using those analytics and different concepts. So today we have Aditya Arora, the CEO of Faad Network. So he's an alum of College of Business Studies, University of Delhi, and at such a young age, he's won a lot of awards in his name. Microsoft Change, Parliament Award, and he's a nominee for Padma Shree 2020 Award also. So without wasting much time, I would like to move directly to Aditya and ask a question: how this journey has been for you?
Thank you so much, Apurva. Thank you so much, Ritika, and the entire In Conversation team for having me in this conversation. And thank you to so many of our participants as well. We about 20 plus of them who have joined us late at night, about 10:06 at night, to have Gyan sessions and to discuss on angel investing, to discuss on my journey. That is very motivating for me, and that also shows the kind of fire we all have in order to be able to succeed in life, right? So yeah, with that, thanks once again for having me, and thanks to everyone for joining in. Yeah, coming to your question, Apurva, it's been a very exciting journey. Although just been about 3 or 4 years since I started my career as such, but to be very honest, every day has been filled with action. It has been filled with a lot of struggle, and has also been filled with aspiration and hope that like you carry on, and of course, whatever you get along the way, pick it up and embrace it with full satisfaction and happiness. Right? So it's a journey where, of course, I'm an accidental entrepreneur turned angel investor. I never thought of becoming an angel investor, to be very honest with you. I had that very fixed career path, and I'm sure you would relate, since we are from the same college, that once you go into CBS, you'll probably give your CAT examinations, or probably you will sit for a placement, you'll get Bain, and you'll get in a company called Bain, of course, which is the next coolest thing after getting in CBS. So, but then, of course, I had something different, because then it's a shame in some manner that the name business comes in the college name itself, but a lot of people don't focus on business. In fact, if you look at the number of students from CBS, even less than 2% of them would be entrepreneurs out in the field, and that's what I discussed with our teachers and principals as well. So that's what motivated me to do something different, to explore something beyond ordinary. And when FAD came to hire interns from the college, I was selected to be one of them. And I was just hired not based on the kind of knowledge that I had, but based on the kind of passion with which I wanted to learn things and wanted to execute about the system. The first 2.5 years of my journey, I did not even earn any stipend out of it. And my work was also not something which brings which brings happiness on the face of any business student. My work was just interviewing people, right? Getting to know about their story. It was not about preparing spreadsheets, or it was not about preparing CAGR models, right? It was just exploring people, talking with them, what drives them, motivates them to become entrepreneurs, because it's not an easy journey, and there's always an inherent opportunity cost in entrepreneurship, more so than in other careers, right? So what is that opportunity cost, and what does that mean to them, and why are they? And when I collected all of that, and when I was going through that journey, so simultaneously, all of that related to me to an extent that I thought that maybe if they are successful following their passion, I can be too. And since then, FAD as well also uh, pivoted to multiple models. We started with acceleration when I was an intern. In fact, I was the first person at FAD. We had just started. So even though I was an intern, I was the core team, right? Because there were just 3 people. So when we started, we did acceleration. We met a lot of people. That's where we built the network. So we met entrepreneurs, we met investors. We asked them, what is the one thing that maybe if given to you right now would help you ease out your journey in the startup ecosystem? And we got tons of answers. We got investments, we got accounting, we got co-founders, we got technology, we got tons of answers. And we started out sort of answering all of that questions, right? If there it was technology, we were helping them connect with the technology people. If it was finance, we were getting funds from them, from the investors that we had met. If it was co-founders, we did events on co-founder matchmaking for speed dating sort of events. And that's where I also grew in my journey, because I was inherently a front runner part of this, wherein I was not only organizing these events and hosting these events, I was also planning these events in the background on how we can make it more innovative and inclusive for everyone in in the room, right? So Faad also grew then. Of course, in 2018, in 2017, 2018, we made a very pivotal move, wherein, of course, we decided that we can't be the best providers of every service, right? So it's like that you can only excel at one service. Either you are the finance guy, either you're the technology guy. You can't be excelling at all the services. That dilutes the brand as well. If Coca-Cola comes tomorrow and say, I will sell chips by the name of Coca-Cola, and of course we will not buy that, because we have always associated Coca-Cola with that drink, right? So it dilutes the brand if you go beyond that. And so we thought that we have to pick one service. We picked investments. For us, fortunately, that worked out. We invested in about 5 companies. The very first company that we invested in was called ClearDekho.com, which has now become India's leading budget eyewear retail brand in the country, having almost 76 stores across country. And when we invested in them, they had 1 store, right? And that's where we picked up their journey from 1 to 76. And not only they gave us tremendous returns on exit, but they also gave us that confidence that our very first company sort of hit the home run. And we never looked back beyond that. By 2017, I'll just quickly summarize all of that up. Although the journey has been very, very long, but I'll just quickly summarize that. So by the end of 2018, we had done about 5 investments. ClearDekho was one. Then we had picked up some early stage consumer brand companies called Stylework, which was managing co-working spaces, Nature Tattva, which was basically building a DIY organic brand. And it was using the the women entrepreneurs in rural areas to create those brands. So that was an interesting model we picked up back then. And yes, by 2018, we sort of decided that it is taking time to close investments, right? I was roped in the CEO by that time, because of course I had been one of the front runners in executing that investments. More so with ClearDekho, I picked up ClearDekho when no one in the market even realized that there was something by the name of ClearDekho, right? So that's when the results started sort of coming in. I was roped in the founder, one of the CEO and partner at Faad. And we then decided that there was just one last thing. So we had focused on our core revenue or our core business operations, but it was taking time to close. In fact, the ClearDekho deal that we did took 6 months for us to close a very small check size. And when we realized that if it will take this much time, then we'll probably not be able to help those many startups. We'll probably not be able to survive ourselves as well, because for a player like us, the entire business model is centered around when the startup gets funding. When they don't get any sort of funds, we don't make money, right? So we make money only when they get funds. So we can't survive like this. It's not sustainable. So what we did is we had met so many people by 2019 that we sort of decided to have all the investors at one place. And that's where the genesis of Faad Network began, right? Where, of course, we created an angel network where every investor that we met was now a part of member network at Faad. We had this, we sort of started doing this conversation over Zoom, over online. We used to select 3 startups for pitching. These 3 startups were raising capital anywhere from 50K to 500K USD. And we did these monthly forums since November of 2019. You would be surprised to know that 2 years, it took us 5 deals to close. Since November 2019, we have almost closed 15 of them. So the rate has been very picked up. The accuracy also has been picked up, because out of 3, we are almost closing on average 2 every time that we are pitching, right? So that's a good way. And COVID also, I would say it's been a blessing in disguise, because everything turned online after that, and for us it was much easier to close transactions. So yeah, that's a brief journey. And yes, now we are angel investors ourselves as well. So we invest in startups personally as well, in terms of whatever capital they raise, because now we will realize this funding we can do, right? We can bridge that gap of we can bridge that lead time for them to raise capital. But beyond that, we need to also sort of grow them to the next level so that we can have multiple rounds of capital, because that's how a company grows. So now we've taken equity, we've gathered that experience as well. In fact, for me as well, it's been almost the fifth year now in the ecosystem. So with all of that, we are helping drive startups. Yeah, that's been the journey.
Great, yeah. I mean, it's too good to hear about startup and this ecosystem, that how it works. And I think before I and like we switch gears to understand idea pitching, startup funding, and the likes, I would just want to quote here that while Aditya was talking about his initial journey, I have picked up few pointers which I understood and kind of relate them because I have worked in startup ecosystem as an advisor. So acceleration, pitching people, getting investors on board, all these things are a step towards your good funding. So all these people that when they go about a Faad network and they're even more in the system, so all these people put a lot of efforts in getting one deal closed, in getting one investor on board, and they're not easy to tap. I know there are plenty of there in the market, but then good players are not easy to tap. So kind of very, very commendable work that you guys are doing here. And now I would like you to take the lead and talk about idea pitching and startup funding.
Got it. Got it. So thanks, Apurva, for your comments. It means a lot. So as you said, that it takes a lot of time to close any transaction, because what founders eventually look for is that they want to close transaction as quickly as possible, because they want
Right.
operating cash to go ahead. But investors are putting their own capital as well. So what startups fail to realize in India is that investors are also human beings. They have capital, limited capital sometimes, and even if they put capital in some place, and it's particularly in startup, it's the most riskiest asset class you will ever find in the world,
Right.
right? It's the most riskiest, and equity is the most expensive, right? So that the two things, of course, make it a very, very tiresome process, right? So the lead time for any investment in India typically takes about 3 months, right? And the reason it takes 3 months is not because so capital. I have to just send a credit to an account. That's a 2 minute process, 2.5 minutes process. Or okay, I'll add the beneficiary, so now it's 24 to 48 hours, and then of course I'll send. So max to max, a 3 days process, right? But beyond those 3 days, that is the final outcome, right? Beyond that, we need to evaluate the founders. We need to look at a whole bunch of factors before making an investment. And these bunch of factors are not only pivotal for the current round, because a good investor would exit 3 years or 5 years post that. They're not exiting in 1.5 years. They will barely make any return in 1.5 years.
Correct.
Right? So a good exit, maybe an acquisition, or maybe a very good strategic buyout, right, would happen in the next 3 or 5 years. And for that, it takes time. So what we are looking for is not the current sort of play. We are looking for is the 5 year timeline, right, of how the business and the founder would grow in those 5 years. So what is the factors we look at? Let me start like this, right? A pitch deck comes to us. What is the factor that we look at while investment? So personally at Faad, I look at 5 T's of investing, right? So what are those 5 T's? The very first important T we look at in investing is called team, right? Why we look at team? Why we place it the most important factor? Because team is something that is not changing, right? The founder's vision or the founder who's running the show is not changing. Business models change. Everything around you changes. How you are in catching your users in the catchment area. How are you mining more revenue out of them? Everything changes, but the people running the show don't change. That's why we look at team. And in the team, we are also looking at a founder's market fit. What we always hear in the market is a product market fit, whether you are building the right sort of product for the market, right? But what we essentially look is the founder's market fit. What sort of industry is the founders in, right? Does the founders have capability and that knowledge to execute their idea in that industry? And also in terms of the insights they have, right? Are they someone who's from outside the industry or someone from inside? And even if they are, what sort of insights they have on that sector, right? So if I'm investing in, let's say, edtech, I would not invest if I don't know the views of the founder on education, right? If I don't know the views of founder on the larger set of problems that we have in our country, right? Because even though if it's not directly related to business, the founder is in that whole system, right? So that is important. Then the second T we look at is called technology, right? Technology is a very important tool. And most of the startups right now, they confuse technology with a basic Google form or a website, right? That's not technology. Your technology can be basic. We are not, as investors, we are not asking you to code like very complex stuffs and bring it to us. We are looking for is the kind of technology are you building? Is this the right kind of technology to solve that problem? Right? That's what we are looking at. If you are, let's say, trying to solve the problem of pharma supply chain in the country, are you building a direct platform or a SaaS platform, or are you building a referral platform? That's the kind of technology mode that we think that what kind of way have you adopted to solve this problem, right? That is the second thing. And technology, of course, is always adaptive, right? So if you're always just displaying your current set of technology and not telling to investors that how will this technology grow and handle more users or handle more new propositions, then of course, as investors, they get a bit cynical. The underlying factor here is that investors look for just one reason to exit a deal, to not invest in the startup, right? Just one reason can be the smallest of one, right? Maybe the founder is rude, maybe the founder joined Zoom call late. And this has happened, right? This has happened with one of our deals. One of the founders joined the Zoom call late, the investor was very punctual, he did not invest. So they're just looking for one small bit of reason. And while startups are giving them 50 different reasons to invest, right? So that's where the odds are not in your favor. The third aspect we look for is called traction, right? That's the most important aspect, I believe, after team and traction, a team and technology. So traction is not just about how much revenue you are making, right? That's not just about that. It's also about what kind of business outlay have you projected in terms of the customers you are talking to, in terms of the pilots you have done, in terms of the POCs, the proof of concepts you're trying to do in your own particular sector, that this idea that I'm projecting actually works. So it's everything, right from contracts to purchase orders to bills of discounting to invoices. Everything falls under the part of traction, the larger part of traction, right? That's the third T we look at. Even if it's not a revenue-making startup, what investors typically look at is, even if it's an app, what's the kind of monthly active users you have? What's the kind of daily engagement you have? What's the kind of daily active users you have? What's the retention rate? So we look at these sort of percentages and metrics. The last T we look at, no, we've done three T, right? So the fourth T we look at is called target market. That's another one very important T, right? Most of the investors in India now have started reverse engineering, right? Earlier, the investors used to just ask traction. What is the traction? And on that was the biggest selling proposition. But now is the paradigm shift where investors in India have become more wise. They are asking, what's your total available market? Even if, let's say, so it's like a perfect analogy, right? That even if you are the smartest in your class, you are in the wrong class, right? So what investors want to check is that are you in the right class? Are you building the product for the right kind of market? Because even if you get the best traction from there and you are in the wrong market, that would not matter, right? So that is something that we are looking at. And the last T we look at is, of course, called terms, the investing terms that you are offering, right? Because as I said, in early stage, there is no way you can predict the valuation of a startup to its fullest. You tell me any method. There are multiple methods, right? From discounting cash flow to cost method to comparables to anything. Everything under the sun is there to get the value of a startup. But nothing can predict it to its best, right? Because in essential, every model is that you are forecasting data and you are bringing it to a discount rate and getting the value today, right? And that's how you're doing the valuation. Now, in your forecast, you can do anything. You can say your year 2 revenue is $10,000. Your year 3 revenue is $150,000. That's how automatically the valuation jumps. But what is the basis of that, right? That is something that, of course, we want to check as investors. So beyond valuation reports, because valuation report, anything can be structured, right? I can tell the valuation of a startup $1 million today and also 100 million today. Yeah. I can prepare that in the report. I can literally sign it as well. And you can use that as a reference. But no one would agree to it because the assumption that I'll take would not be realistic, right? So decide the right kind of valuation and also decide the right kind of money you are looking at. So most of the founders come up to me and ask me, what's the equity dilution we have? What sort of equity should I dilute in the early stages? There's no one answer to it. But typically what we have seen is that equity dilution in early stages round can anywhere be from 10% to 25%. That's how broad it is, right? It should not be more than 25%. Otherwise, you would lose ownership eventually of the company in a few of rounds. So that is the broad dilution. But how I typically tell all of my founders, my portfolio companies to decide the valuations of their round is that you decide that what is the capital you want to raise, right? Okay, this is the I've done my calculation. This is my operating cost. This is my expansion plan. This is the capital I want to raise. Now you take that capital and say that this capital will help me to grow this much. Okay, so let's say if I'm right now at a current monthly run rate of let's say 2 CR, that will help me to raise 4 CR for monthly run rate within this amount of time. So what you are essentially saying is that within 6 months, let's say your revenues would be double, right? So your valuation would be should be impacted in that, right? In multiples again, whatever multiple do you want to take off your revenue? Don't take it as high as something that is beyond even explanation. Some of the startups take 100x of their annual revenue, which is to my mind, this is something which is mind-boggling, right? You can't take 100x on an ARR, right? Even if whatever your industry you are in, just take whatever you think you can actually execute. Because even if let's say you take 100 ARR, even if you take 100x, your valuation, even if you take $100 million, always remember, guys, the next round that you are raising should be plus of $100 million in valuation. If it's minus of $100 million in valuation, then that's a down round for your company, right? And you will never be, any of your investor would not approve that because legally as well, they have the first right to refuse it in any of your rounds, right? So that's why play very smartly the valuation that you can chase as well. Okay, don't make it a valuation game where you're putting lofty valuation and you're not chasing money out of it, right? So that is thing. And one very important myth is that a lot of marketplaces, particularly marketplaces like Amazon, where revenue is different from transactional value. So even if let's say Amazon does 1 CR of transactions on its daily platform, their revenue would be barely let's say 1,000 rupees or whatever percentage it would be. It would not be 1 CR, right? So don't take a valuation beyond your GMV because GMV automatically improves when you put money in any startup. That's how marketplaces are. These are some tips and tricks that we use to evaluate a startup: team, technology, traction, target market, and terms. So these are the 5 T's of investing that we look at. And of course, once that is done, if that is done, funding is the outcome. We can sign the SHA, we can read your term sheet, we can do the due diligence. In fact, in early stage startups, there's hardly any due diligence because there's no history available, right? So due diligence is more like a formality that most of the networks do, right? So that's how you execute that investment.
And from your experience, so you talked about the investor side, you talked about the person who's there to fund. But how about the person who's there to have the funding? I mean, how do you think a founder or the team should go and pitch the idea? Are there some key requirements that an investor looks for when someone places their pitch?
Okay. Again, see, investing is a confidence game. To be very honest with you, there were people who backed Harshad Mehta as well,
True.
right?
True.
Yeah, sure. They sometimes when we are investing in any business, we are investing more so in the founder's vision to execute that. Right? We are not investing in the business fundamentals ourselves because the very purpose of an angel investor is that they bring the things towards a perfection, right? That's why they are called angel investors because they turn around struggling companies. That's the actual definition of it, right? So if they're turning around struggling companies, then of course the assumption is that the company is already struggling. So you
Yeah.
can't expect everything to be perfect, right? That's your job. You are taking equity in that. It's your company. You have to help them. You don't have to spoon feed them, of course. That's not something that we want in our founders. We have to help them to grow to the next level. So the founder should be confident. That is A. B should be clarity, right? Even if let's say they don't have very strong numbers to back everything, the clarity should be as such that the vision aligns with what numbers you're saying, right? Because any number is justifiable as long as your vision supports it, as long as your plans which are there, they add up to that, right? So that clarity should be there, not just from the numbers side, but also from the vision side. A lot of founders that I've met, Apurva, a couple of founders, they come up to the office and say, we want to be, let's say, the biggest player in the travel industry. We want to do this and this. And the other founder says, no, 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 no. Maybe we can do this and also do this. So that's a clear-cut sign that the founders are also not on the same
Same
page. Right?
page.
So that of course should be there, and yeah, that is what we all look for. And third aspect is exit. Of course, whenever you're going to investor, exit is something that some investors would automatically ask you, right? They're very upfront in terms of asking that, what sort of an exit have you planned? And most of the founders, most of the responses that I give, 95% of them is, we never want you to take an exit. We want you to go till an IPO. Okay, this company will go to an IPO, then you will make your money. Which may be visionary, right? But it's technically not possible because you can't have an angel investor till an IPO. Every investor would take an exit, only the private equity stay for you before you go to an IPO stage. So that's the process. So it's not that every time you say it as an IPO, okay, sometimes it's good. But most of the times, of course, you should always be open in terms of what kind of mutual synergies can be meted out or what kind of collaborations can be meted out. A merger or an acquisition or a strategic buyout is not always a loss for the company, right? Sometimes it's more of profit as well in terms of taking their brand ahead, taking their brand forward. So yeah, that's about it. Never be married to your idea. The last thing is very important that I missed is never be married to your idea so much that you forget taking feedback, right? These are investors who have walked the path, and we almost get so many deals today these days that every investor claims to be the best, right? So always be open to feedback in terms of accessing and accepting your mistakes and moving ahead and learning from them. Yeah. You don't have to, it's not a job interview where you have to be perfect in terms of an angel investor. Be honest, be clear, and have vision, have clarity. That's how you win an investor.
True, yeah, because I think as an entrepreneur, we all take a lot of risk, but then risk has to be calculated at a point of time. Matlab, you can't just go on taking the risk and say, "Okay, we'll go till IPO or we will be the leaders of the industry that we want to enter in." You might take a different path at any point of time. So obviously, a plan B should be there or a risk planning should be there that as to what to do if that doesn't work out. Okay. So, how's your take on seed funding? Because I think we have received a lot of questions from people on seed funding as to what to do with that seed funding amount that we normally get and how we should, initiate the functions in our venture with that funding.
All right. So see, with seed funding, the broad heads of investment are a called product development, where you of course are taking seeds to develop your product further, right? It may be in the prototype stage and you want to put funds in it and make it to the final stage. That's one of the aspects. Second aspect of seed funding is of course team building as well, because a startup is growing and they want to have more people in the room. So that is the second aspect. The third aspect is called research and development, of course, because at seed, the very purpose of seed is that you're not there, right? You have just started. That's where the seed is, right? That it comes from the plant, right? When you grow to a plant, is that's where your proposition changes. But when you are a seed, you need water, you need capital, you need soil, you need sun, you need every kind of thing. So when at seed you are just starting up, founders also sort of invest money, as I said, in R&D, limited amounts of marketing, not of course like a huge marketing budget or sort of that thing, but a very limited amount of marketing in terms of going ahead. And of course, the last thing is called operations. So in terms of managing their existing operations, putting capital behind operating things in your business, paying money to your creditors. But these are the 4 or 5 different broad heads of raising seed. But what are the not? What should you not do with the seed money? Is of course invested very lavishly in public relations, okay, or invest lavishly in invest very lavishly in paying out loans as well. Sometimes some of these startups actually take these kind of money to pay existing loans, which can be easily be sort of found in the due diligence report, right? So of course, not use sort of money to set off another thing in your business. Every seed money, as in the underlying point is that seed money in the business should only and only be used towards the expansion of business. anything that deters the expansion from any sense, either be it for loans or either be it for investing lavishly in PR or investing lavishly elsewhere. If it's not helping the operations, it's a waste of money. It's burning money, investors' money at a seed stage. And when you burn investors' money at a seed stage, trust me, no one would come and invest in your next rounds.
True. So probably seed funding and using that fund cautiously is one of the key factors to keep your idea and startup running.
Yep.
Fine. Uh, Ritika?
Right. Uh, yeah. So Aditya, I mean, before we move on, let's first talk about how do we come up with the exact amount of funding required. So you've already told us how to use the amount well, where to use it, where not to use it. But then how do we get to know the exact amount that we require?
It's a very interesting question, and there are various sort of perspectives on that. One perspective that I particularly like is the reverse engineer perspective, where it tells that startup is at point A, where of course it's right now at this and this traction, this and this product and market penetration, or this and this, let's say, customer acquisition. And once they go ahead to a startup to a point B, the metrics would of course change on the higher side, where customer acquisition of course would come down, where market penetration would go up, where technology would improve. So what we need to identify is first identify your growth drivers. When I say growth drivers, I basically mean to say is that what is the sort of thing that you want to display in the front? What are your top line numbers? And what sort of metrics are you tagging, right? If you first define the kind of growth drivers you have or the metrics that you are tracking, then what it gives you is to identify these core aspects in your, right? And in these core aspects, what you can do is you can estimate and assess that these are the kinds of rounds that I'll need to do. Another thing is called runway, right? That how much time do you have for this capital to use, right? In how much time your capital would be extinguished. So in that sense, plan that this is the capital that would sustain me till now. This is the capital that has sustained me till now in terms of this operations. When these operations and these numbers go up, then of course more capital would be required. Now, how much that capital would be able to survive that? You don't have to be perfect. To be very honest, it's not a fixed deposit, right? That you say to investors that, okay, 9 months is when I require the capital for, I would require 20 lakhs or 30 lakhs, right? And if you, let's say, extinguish that capital before that, and if you, let's say, exceed that capital, so it's not that investors, of course, would question you because it's business. Anything can happen. Also, don't take too much capital. Stuff yourself with the capital that would just need you to help to get to the next stage. So it's not like if you're in the food business and you want to be the next Zomato, that you raise, let's say, $1 billion all at once and go to the next level. No one would give you. Raise that capital so that you can grow at least to the next stage, which is your 8 to 12 months. Typically, an angel round has a runway of 12 to 18 months. So within that, estimate that what is the capital that will require me to finance that business in the next 12 to 18 months with enhanced operations, and then reverse engineer it. That this is the capital that I would require at this in this year. This terminal month would be very more important. And that's when you get back to the calculation of the capital. Even if you fall short of capital, there's a concept called bridge financing or bridge round, wherein you're not raising the next institutional round of capital, you're raising a middle round, which will help you to get to that next round. So of course you can anyways have that option of a bridge round wherein you can finance that capital for short periods of time with your existing investors or get some new investors. So yeah, that's how you basically arrive at this maths. It depends on industry to industry, but the basic principles remain the same.
All right. Yeah, so this was pretty clear, Aditya. Thank you for the answer. Okay, slightly deviating from the topic at hand, how do you think a bootstrap startup can be scaled? I mean, have you seen any bootstrap startups so far in your career, and what have you advised them, or how have you dealt with them?
Bootstrap startup, this one perfect example of a bootstrap startup scaling, which is of course the biggest startup we have in the SaaS space. And since the chat box is not active, I would love if um, our participants can give that answer, right? What is the what is the most successful bootstrap startup in the SaaS, in the software as a service space? Would be great if you can type the answers in the chat box. Can be wrong as well, don't worry. I'll repeat my question. So what's the best startup you've seen bootstrap in the software as a service space?
It's so I know one startup. So NPF before, I mean, of course, it is from InfoH, but initially they have started Bootstrap, and they are growing exponentially well in SaaS.
Oh, sure. So there are many startups that are growing that, but I'm asking for the most successful startup. My captain in EdTech, yeah, my captain, yeah, it's a growing startup, but the name starts with Z. The name starts with Z. It's a four-letter word. Starts with Z.
Zoho.
Yes. Who said Zoho?
Ritika.
Oh,
Zoho.
Ritika. Yes. Now
Yeah.
everyone is saying Zoho, right? I guess Piyush, your answer was right as well, Rahul. My captain is also growing well, but Zoho is the answer that I was looking for here in particular. It's a perfect case study for anyone who wants to study bootstrap startups, right? Consider someone like a Zoho, of course, reaching to a valuation of $1 billion and above, and even without raising any capital, they literally shook the chair for Salesforce. We've all tracked that news, right? Salesforce was literally terrified at their growth when Zoho sort of picked up operations really well in United States and outside, and that's where Zoho is a perfect example where and how they have been able to do that. So Zoho's founder is Sridhar Vembu. Sridhar Vembu, his vision from day one was to not chase capital to satisfy customers. His vision from day one is to provide a quality assurance platform, something which comes as a trademark for quality, helps people scale their businesses, manage their businesses well, and just focus on customer satisfaction a lot. Similarly, there is another startup that I would like to call is ID Foods. All of you have heard of ID Foods, right?
I am Bangalore, yes.
ID
He
Foods,
was a
right?
Bangalore guy.
Yes, Mustafa PC, the founder of ID Foods, perfect case study. I know the story in bits and pieces, but it was like that people in their homes used to face a lot of difficulties while preparing the vadas. Right, vada is a very popular South Indian dish, and vadas used to break very easily because they're very soft once they come out. So what they did, and they had very difficulty in shaping that vada because vada is that concentric circle, right, that we all tasted and had before. If it deviates in its shape, the very beauty of vada and the taste of vada also goes for a toss because you would never like to have that vada. What he did was he created a nozzle kind of a system where it was like the shape was this. On that very shape, you could prepare your vada. You could easily sort of dough your vada. These vadas were very healthy in nature as well. The flour was very healthy as well. And that's how the genesis of ID Food started, right? Many companies have a tell you like that, even with Zoho as well. And all of these companies have one underlying thing. They knew their customers well. They were serving to their customer satisfaction from day one. And they never lost touch of their customers. They understood them, and they built the business not through external financing but through internal, and also through revenue financing, where they were investing their revenue, their top line, to such an extent that they had the liberty to invest that money back into the business to finance or fuel their growth. And that's where the essence, or that's where the growth story of Zoho started. And similarly with ID Foods, most of the companies that you look global, which are bootstrapped, all have that same underlying, that they know their customers well. Most of the companies today in India, we had the question of the likes of Zomato and Swiggy. They're burning money because they don't know their customers well. They are spending money to know their customers well, right? And that's where the customer acquisition cost is driving up. When you are burning money to know your customers well, that's when you don't know. You are in a land of uncertainty. You will invest in marketing, you will invest in research, you will invest in SEO, you will invest in SEM, you will invest in influencer marketing. You will do everything that you can win the trust of customers. while the customer's trust can be only won by the quality of your product and the quality of your customer service. So yeah, that's the key. And until date, my personal experience with Zoho has been very good too. They're very, very quick in their customer response, their customer feedback. I'm not sure if you've had any bad experiences with them, but on my side, they've been very, very quick to execute things, even till now. Yeah, that's
Yeah.
the
Yeah, Aditya. I mean, I've heard similar feedback from a lot of people. So I mean, Apurva and I, we happen to know the associate vice president of Hotstar. So he himself vouched for Zoho's performance and how good their customer service is. I mean, versus a Freshwork or a Salesforce, even a Salesforce CRM. So yes, you're right. Okay, so while we are actually talking about a Swiggy and a Zomato, would you want to comment on how to get funding for cash burning startups, the initially cash burning startups, or even at the later phases? Yeah.
got it. Got it. So the point is that of course Swiggy, Zomato, all of them, and as there's a comment in the chat box as well, that all of them can move towards IPO, but these companies are very, very far from that. They've been planning IPOs not since today, but since 4 years back. Even Oyo, for that matter, has been planning IPO since 2013. But the requirements there are not very easy. You have to be profitable for about 3 years so that you can list on the exchange. And that's where the fault is. So coming to your question, Ritika, cash burning startups mostly are the models where we see in the B2C side, right? B2B startups technically are not that cash burning because the customer acquisition cost is a bit low. And even if it's on the unit economist side, if it goes a bit high, the returns are much because you're not selling for a person, you're selling for the entire entity, right? And the contract value from an entity is much greater than it gets from an individual customer. So for startups in the B2C space, see, burn would happen, right? Sometimes it's not a choice as well because investors need that growth. Startups need to expand beyond their own set of customers, and they would need some sort of inorganic marketing somewhere or the other to get those customers. So I'm not saying that burn is bad. Burn should happen, but it should always be limited. So what we technically say that if your revenue is 3/4 and your burn is less than 1/4, then that's a profitability situation. Then you can go ahead in the long term. But if your burn starts exceeding 20% or 25% of your top line, that's when you go wrong because you have operating, you have overheads, you have so many other verticals on which you have to spend costs, and you can never be EBITDA positive or profit after tax positive in your lifetime. So typically businesses which have high customer acquisition costs, they should think of alternative source of marketing in terms of bringing their cost down. More researched campaigns or more innovative campaigns generally have the highest reach. Consider a thing like Cred, right? Cred is also a high cash burning model, to be very honest. And they have raised, if I'm not wrong, they've almost raised 500 million above easily across so many rounds because they need cash and they're not building something credible out of it as well. They're just collecting data. But can't see their marketing campaigns, right? Not everyone gets it. And with all these actors, and some of these actors, in fact, are not even real actors, right? If you read the actual story of Cred campaigns, these are all like the second copies or the third copies of these actors. So they are spending so much because in India, when you get the maximum eyeball time, right, that's when you start converting a customer. In India, customer does not convert very easily because there are various alternative choices, and there is various sort of predatory marketing as well. The moment you see a Coke ad on TV, you would see a you would see a Pepsi ad right next to it, right? And that's where the market Indian sentiment is, and companies have to invest that cash. So that is the problem. But once you sort of start building a brand, when you are known by your quality and not by the marketing campaigns, that's when the investors are ready to fund your growth. Even if it takes a hit on your revenue, they're ready to fund your growth because They see the brand building out of it. They don't see a marketing campaign building out of it. They see a real brand with real quality products building out of it. So that's how you should focus towards. Even if your burn is high, focus towards getting quality. Focus towards your customers right from day one. That's how you win any investor in this sector.
Aligned. Sure. Okay. And what do you think is a minimum turnover, or how would you depict the strength of your own company before asking for money? I mean, in plain basic terms, what is the minimum turnover that an investor generally is looking out for? So, I mean, if you have a range in mind.
So again, a very, very subjective question. Again,
Right.
the turnover, there is no as such turnover figure with which we sort of go with startups, right? What we are looking at is a path to profitability, right? Even if you're earning 10 lakhs, what's your path to profitability coming in the next 3 years, right? That's what we are focused towards. So yeah, I would say there's no number as such. Just go ahead and depict what is real, but show that path to increase that revenue multifolds. If it's not, then that's the loss of the business as well, right? If they're not able to double or triple their chunks of revenue in the coming time, then that's something business which is not highly scalable or which takes time to sort of hit the market. The time to market is a lot. So there is when entrepreneurs go wrong. So no turnover as such, but the path to profitability should always be clear. Yeah.
Right. Okay, so let's move on from funding and let's go back to idea and pitch. So how do we exactly prepare the business idea deck, or how do we use different models in order to document our business idea for the investors? So if you have some set template or a couple of things in mind. So we are aware that Ratan Tata, I think a couple of months back, he actually gave out a investors deck. Do you think that is comprehensive enough, or do you think there is a couple of things more to be added?
So there are multiple, like there's one Ratan starter deck if you find. There's one startup by the name of Find, which is FIND, which was acquired by Google. Their deck is also publicly available in terms of what did they put in that. So you can refer to that as well. Both of the decks have more or less the same components, just that some decks sometimes have to be a bit detailed because investors like some of the detailings, right? And it depends on investor to investor. Most of the startups right now even don't forward the same deck to everyone, right? They prepare a customize the deck for every investor. If it's a Sequoia, they'll probably prepare a different sort of format because they have sometimes invested in the competition as well, right? So they have to sort of evaluate that and put that accordingly. But more or less, the points remain the same, right? As I said, what's the team that you're building? What's the problem you're solving? What's the solution that you have? What's your go-to-market strategy? Or how do you plan to raise funds? What sort of allocation do you have in all of these funds? What's your case study, right? What's your user case study? That have they used the products? What have they found from them? Which of these fields are the most attractive to them in terms of use cases? And yeah, these are the broad set of activities we look at. But I'll also quickly show you a quick template, which will give you a brief idea of what. Again, this is very exhaustive, but this can give us a very good idea of how we can. Just give me a minute. Just quickly share my screen. Great. So just give me a minute. So this is visible, right, Tika?
Yes.
Yeah, I'll just quickly walk you through it. So basically, it's a deck of a medical startup, which eventually in the first slide it gives you a very quick overview of the entire things, right? What kind of value chain they have, what kind of percentage they're doing with, and other competitors. So in the first slide itself, it gives you the entire set of gamut of things. I'm not saying this is the right thing to do, but of course, for people who you think and are not will not invest a lot of time in reading your text, this is a good strategy. Then in first slide you just give a quick synopsis of what like an executive summary. So the first slide was executive summary. This is a milestone slide, of course, which talks about the journey till now. everything. It covers everything, right from revenue to getting your first customer to getting your first investor. And of course, this is like a solution slide which talks about the kind of solution. Startup name though has changed, but of course the kind of slides that are there, the heads, just look at the heads, those remains the same. Also talks about who are your customers. The startups don't talk about, right? This is called target market. So who are your customers, what ages they are in, what kind of data do you have to back them? So that is something that of course is very value added. This is a market study which a lot of startups don't put in. What's the total population and what sort of growth are you expecting? There's something called a TAM, there's something called a SAM, there's something called a SOM. So TAM talks about what are the total number of people that you can address. SAM talks about what are the total number of people that are available to you, right? That you can take the market share of. And obtainable talks about, service obtainable market talks about what are the number of people that you can obtain within that market. So these are the three sort of things that we broadly look at. Of course, then we look at the problem slide, we look at the solution slide, we put the whole solution, we look at the competition analysis slide. So then we also divide the competition on the basis of a matrix where we talk about which are the startups which have received funding, how many players are there in this particular segment, what is the USP, what are the challenges. So that's what we talk about. We give this is optional. If someone wants a detailed competitive analysis, we can provide this as well. These are mostly helpful where investors have invested in a similar startup. So these sort of analysis help them to break the ice that why this is different from others, from my own company. This is that, and then of course a DNA sort of what's your mission and your motto. You should always be clear with that. This is again brief overview which talks about okay, what sort of startups, what sort of things are we doing in this particular startup, how are we sort of taking the collaboration, how are we doing the marketing, how are we doing the brand building, everything. Then of course we look at the founder side. In some of the decks, I tell the founders are solid, strong background. Put this slide up at first, right? Because this gives a very good impression, of course, that these are founders that we should actually back. So you can mix it, like you can play around the slides, you can play around the dynamics, but broad heads, yes, they remain the same. Then sometimes this also becomes very important.
Correct.
Right? Wherein we talk about the personal side of things as well. Pitch deck is not just about connecting with investors. Sometimes it's about connecting with the human being as well, right? So maybe let's say your mantra of life is the same as the mantra of investor, right? That helps to break the ice, right? So whatever you want to put it in here, you can put it there. You can make it a bit informal as well. It's not that you have to be 101% formal. These are the places where you can be a very tiny bit informal. So these are the trends that we, of course, this is one of the most important slides in the business where we talk about the growth that they have. This is a past growth. So how have they grown in the past months? It's not a future growth. So this is what they talk about, right? And yeah, put very attractive sort of graphics to it as well to show your growth. Then this is a phase-wise growth that most of the startups talk about in terms of we are at phase 1. Okay. Let's say we are at phase 1, we want to go to phase 2 and 3. What are the pain points we'll be solving? What are the challenges we'll have? Because these two become the basis for your scale, right? If you're not laying this out well, investor would never know what's your scaling strategy. So this becomes a part of your scaling strategy. Then it also covers your marketing strategy as well. Then of course, investment required. Where will I put the capital? Where would I invest? So they're putting in IT infrastructure, furnitures, team and operating expenses, brand building. So of course you can have your own heads. This can become your last. This is your last slide. So your any awards, any recognition that you've get, any media that has covered you, any interview you've had. Please do put it in this because this also helps for investors to look and evaluate how the brand has been received by the public. And yes, there you can put your own. Most of the founders they don't put their contact details here, and that is one of the very big mistakes that they do. Because how would an investor contact you? Sometimes the investors lose track of the email, right? So always put your contact details so that investors, even if they have the deck, they can figure who you are and contact you. So this is the broad specimens I had for pitch deck.
Yep. So this was pretty comprehensive, and it actually covers almost all the the things that are actually anticipated. So guys, if you have any questions, you can populate the chat box, or else you can come off mute and talk to Aditya. And meanwhile, Apurva, do you have any question?
I have one question, Ritika. So, Aditya, I want to know that
Yeah.
how relevant is my social media branding is when I'm at a pilot stage?
A lot. So again, this is a metric where investors have recently started dabbling, because most of the startups they come in and they show very high in terms of engagement within those within their social media. And once we do a social media check, as they say, we barely see a few hundred followers, and they say high engagement within those few hundred followers. So it's more important for us to do a background check, because at the pilot stage everything becomes about what's the customer experiences.
Correct.
And customer experience is primarily driven through where customers see you the most, which is of course online, and more so in post corona it has become more important, because these are the only places where customers are seeing you right now. So the social media strategy should be very well, because if you social media is a very powerful tool, right? If you use that well, it will help your brand to go in the long run. And we've seen so many startups who've used their social media to an extent that they've become very household names. Even Zomato and Swiggy we are talking about, they're very, very active on social media in terms of chasing each other, and also in terms of actively sort of having marketing campaigns, or actively having a lot of campaigns. Durex is a one perfect example of a social media.
When you were saying it, I had the same brand in my head. Ki I do follow that page, and they have created a star for, like, I think everything that goes inside the market or economy, whatever.
Yeah, so consider a brand like Durex has like taken the marketing stream to another level, where of course their marketing and their campaigns, everything is spot on, really spot on. So yeah, use it powerfully, use it carefully, but you should know what are the in the pilot stage, what are the kind of results, what are the kind of metrics you want to track, and use that accordingly. Use that social media accordingly, and invest in social media as well, but limit it to an extent that it helps you to achieve your growth within the limited cost. Yeah.
Sure. Because I know there are a lot more buzz around social media influencers going around who are promoting XYZ brands. So that somewhere turns up as a negative picture for the brand sometimes.
Absolutely, absolutely, absolutely. So again, we have had examples of good brands as well. We've had examples of brands which, of course, in the latest Tanishq example is a perfect example of that, right? The
True.
Tanishq ad, right?
Yep.
Sometimes social media perceives certain message as they're open to. I'm not taking any side, but any social media message is open to sort of subjectivity, right? And you can take it the way you want to. So sometimes good campaigns can go bad as well. We have White Hat Junior, another perfect example of bad marketing. Right? Their ads have been taken down because, of course, the kind of promises that they've been
Evaluations.
yeah, you with a 13-year-old kid is getting coded. They're promoting rat race in a sense, of course, learn coding, and that's the answer to your problem. So many examples of branding going wrong. So use it very carefully.
Sure. Any questions,
We
guys?
have a question in the chat of Apurva.
Go ahead.
Yes. Yeah, so there's a question by Tejas. He says there's a saying, to have a successful company, you need to find a problem and solve it. Is this true? Can a startup be successful if the product they are making has consumers few years down the line? I mean, is it can a
Yes.
product or can a service be before its time? I mean, ahead of its time, I would say.
Has consumers. No, so absolutely. What I guess Tejas is trying to say is that if it's a pre-product stage, where of course the product, or it's a pre-revenue stage, more sort of pre-revenue, where consumers are not there right now, but it can be a few years down the line. And as you said, the idea is ahead of its time. So that's not a bad thing, but the timing of it should be very right. So it's not that it should be like 7 years or 8 years down the line. It is something that should be executed in the near vision. Because if it's down that, no investors would believe that, right? If you are seeing, let's say, I'm building a hyperloop in India, right? Wherein, of course, I'll clear all the roads, I'll clear all that, and maybe that would happen. Maybe that would happen as well. Maybe Elon Musk would do something. He's a crazy enough man himself. Maybe he would do something for India as well someday. So maybe that would happen. But that is right now way ahead of its time, right? So of course you get difficulty more so in India because investors, they focus if they don't see the vision. So it's not that they're not having eyeglasses. It's not. It's just that your vision is just not there right now. Your vision would take time to build. So yeah, it can be done. It can be successful, but the timing should not be too early or too late. It should be at the right time, going to the current market trends, and that's how you study a market before you enter into any idea. Yeah.